Hello everyone, and welcome back to Dr. Tao's Quant Lab. In Chapter 1, we built the foundation. We learned how market mechanics work and how macroeconomic gravity controls global liquidity. Now, we're moving into Chapter 2, and things are about to get highly practical. We're opening the Quantitative Toolkit to decode technical indicators. Before we look at a single mathematical formula, I must give you an important warning. Technical indicators are not crystal balls. They cannot predict the future with 100% certainty. They are simply statistical tools designed to map probabilities. You must always use risk management and never go all in based on a single signal. The first tool in our kit isn't a formula at all. It's the concept of time. Think back to Chapter 1 when we talked about data granularity. We aggregate continuous data into discrete blocks called timeframes or period levels. We have short-term levels like 30 minutes, medium-term levels like daily, and long-term levels like the weekly. Remember our rule about the signal-to-noise ratio? As the time frame shrinks, the market noise increases. That is exactly why we primarily focus on the daily candlestick to filter out intraday algorithmic noise. A massive mistake beginners make is arbitrarily picking a time frame. In our lab, we follow strict time frame rules based on volatility and leverage. If you are trading Forex with 100 times leverage, the asset barely moves 1% a day. But because of your leverage, you must use a 5-minute chart, or that 100% move will liquidate your account. But US equities are different. Stocks have naturally massive volatility. A stock can easily move 10% in a single day or 50% in a month. Because of this extreme baseline volatility, staring at an intraday chart will just chop you to pieces with false signals. You need the daily chart to see the true trend. This brings us to one of the most important theorems in quantitative analysis, the temporal hierarchy. Macro dictates micro, or the larger the period level, the greater is mathematical authority over price action. If you see a bullish breakout on a 30-minute chart, but it is colliding with a massive resistance wall on the daily chart, that 30-minute breakout will fail. Always use your higher time frames to validate your lower time frames. Let's switch over to the trading app so I can show you exactly how this looks in practice. Okay, so look here at the bottom of the chart. This is where you select your period level. And I believe all trading apps, they have similar patterns. You can select which one you want to use. When I analyze a stock, I use a very streamlined top-down framework. I start with the daily chart. I start with the weekly chart to find the main trend, like this, main trend. Then I drop down to the daily chart to actually execute my trade like this. So it's more detailed. And of course, we need to look at the support areas, indicators, structure, technical patterns for trading as well. Okay, now let's switch back to the lecture notes. Remember, I'm only executing during our golden window between 1:30 to 4 p.m. By doing this, I let the daily candlestick finalize its shape, and I completely ignore the intraday noise. You do not need to stare at a 30-minute chart to be a successful trader. Now that we understand the canvas of time, it's time to start painting. In our next lecture, we are going to cover the single most important data point in the entire market, trading volume. See you in the quant lab.